Hi, and welcome to our first episode of REC by Primonial REIM. REC standing for Real Estate Conversation. You will learn about what's happening at Primonial REIM, and we will have in-depth conversations about big trends in Europe affecting real estate and the global economy. My name is Nouria Wazir, and today I'll be chatting with Daniel Weil, Head of Research, Strategy and Sustainability at Primonial REIM. We're recording in Paris, and we are Tuesday the 7th of June, 3 p.m. Hello, Daniel.
Hi, Nouria. Thanks for having me.
Really excited to be hosting this very first podcast with you. Maybe we could start by a quick introduction about yourself, although you're pretty very much known in the business, I must say. Your background, your role at Primonial REIM.
So I'm with Primonial REIM since 2011. I'm head of research, strategy and sustainability. I lead a team of 3 people as for research and 2 people as for sustainability. As you know, Primonial REIM is a European real estate platform. We manage real estate funds. We're one of the first and foremost investors in France, but also in all of the Eurozone. We are basically 400 people and manage 32 billion euros of asset under management for retail clients as well as for institutional investors worldwide.
Great. And Daniel, this webinar coincides with the release of the report Real Estate Convictions for Q1 2022, and this will be our main discussion topic today. The Real Estate Convictions is a huge collaborative effort where your research team gives us insights and trends on the market. This is regular content, right?
Right, absolutely. It's quarterly, and we've got a European real estate outlook and a German real estate outlook. It's important for us to have some people on the ground. We have one senior researcher in Primonial REIM Germany. So basically, when we started Real Estate Convictions, it was out of the realization that there was not really much research on real estate from the point of view of the investor. It was very often so from the point of view of the broker. But of course, as for performance, as for allocation, there was not much literature. So we felt it was necessary to produce some kind of investor's view on the real estate European markets, and of course that's why we have this document in several chapters per what we call real estate asset classes, namely offices, residential, healthcare real estate, retail and residential and hospitality. So we really try to give a view that is informed by, let's say, the tendencies, the trends within these real estate asset classes, as we call them, because we believe they're going to have some very different tracks in the future. And also always try to have the macro view, because it's very important to understand that even though it's always this idea of thinking global, acting local, and in real estate it's very true, because you need to be local in order to seize local opportunities, but also you need to manage risks. And as we know from today's situation, most risks are macroeconomic.
Great. So Daniel, you'd agree that we could start setting the scene by talking about the economy. Looking at the past 6 months, COVID-19 is still being an issue. The war in Ukraine, obviously. What would be your team's view about the global economy over the next 6 or let's say 12 months? And also, how will that differ from what we have already been experiencing?
It's very different because if we go back to the great financial crisis, the GFC in 2008, 2009, it was a financial crisis. It was a crisis that, of course, some had forecasted, everyone could more or less explain by the level of debt, by the subprime mismanagement. But what we've seen since the pandemic is non-financial risks hitting the markets. The pandemic risk, of course, the geopolitical risk, and therefore I would say the current situation is pretty much off the charts. It's pretty much a non-academic situation. For example, what we're facing today is a risk of global stagflation. Stagflation is actually quite rare in economic history. We've had a bit of it in the 1970s in the wake of the oil crisis in 1973-74, but we're in a very different situation. So basically, to answer your question, on everyone's lips there's the issue of inflation. We believe, of course, we agree with the ECB's view that we're going towards a sort of bump in inflation. We're not convinced there will be permanent inflation in the next years in Europe. Maybe the United States is a different case. Yeah. And therefore, we believe that there will be, of course, some tightening of interest rate policy, but not much more than it is already expected. So we believe, of course, we're going towards an inflation about 7-8% for the Eurozone, essentially driven by energy costs and supply chain bottlenecks. So it's not the kind of inflation we had during the 60s or 70s with really wages going up and prices going up and the famous wage price cycle. No, it's more like inflation driven by costs, energy costs, and therefore we don't see hyperinflation coming, but rather an episode of inflation in 2022, possibly a recession, and then back to, I would say, lower levels of inflation. We believe that there's still very much some sort of deflationary factors, which are the aging of the population in Europe, of course, which is the globalization, which keeps prices competitive and therefore low. So that's where we stand, a sort of moderate view of how the next 12 months are going to be.
So your word would be stagflation. That would be the key word.
Yeah, but not necessarily stagflation for many years. We know that we're going to have 7 to 8% of inflation, and the growth expectations for the Eurozone are between 2 and 3-4. So, of course, if we define stagflation as a situation where inflation is very much above real GDP growth, well, of course, there's stagflation, but it's not necessarily stagflation which will last many years. So I believe we probably at the end of negative interest rates, but we're not yet at the end of low interest rates, and that's what's absolutely essential for real estate, because real estate thrives on low interest rates, and essentially the premium between real estate returns and sovereign bond returns, which is, of course, narrower than it was, let's say, 6 months ago, but it's still there. And therefore, real estate is still more or less attractive for investors.
Perfect. So we can say that the high level of inflation will not disappear anytime soon. Fact.
Yeah.
So let's now dig into the real estate market, shall we?
Yeah.
I think it would be fair to say that real estate remains relatively attractive compared to other assets class. This is what you just said.
Yeah, absolutely. With also a dimension which is volatility, because we've seen a lot of volatility in security and equity markets. Of course, real estate has this capacity, I would say, first of all, to I would say to absorb shocks very slowly and on a very long period of time. For example, I would say the current situation in terms of energy costs, etc., has not yet shown into values and cap rates, and the price per square meter in most of the office markets. So it's a market that absorbs very slowly external shocks. And also, it has to be said that inflation has also a positive influence on the level of income returns through indexation. So it's not mechanical, of course. It's not because in your lease you have an index based on CPI, on inflation, that necessarily you're going to raise more income as a result, because of course it's always negotiation between the landlord and the tenants, but still inflation can have a positive influence on the income streams, and that's a big strength of real estate right now.
Perfect. From the report, the office market is definitely on the road to recovery. Can we say it's both an occupation plus investment?
It's I would say recovery, because the level of investment is, let's say, still below what it was in 2019, more similar to 2016, 17, 18. So it's not too bad. It's not bad. The market is still liquid. I would say the investors are still raising some questions about the office market in terms of how the market from home trend is going to be absorbed by the market, by the tenants. In that respect, what we saw is that it's very different from one country to another.
And from one employer to the other. For instance, Tesla, which does not want his employees to work from home.
And even Google. I mean, if you've seen this letter from the Google direction to their employees, it's actually a very surprising view from Google, but they're quite moderate on their working from home strategy, because what they say basically, and I think every company is going to come to this realization, it's that you need, of course, to have some flexibility, but you also need to be working together, and that means probably in offices or in some premises which you are going to be able to have some sense of community. You're going to be able to do presentations, etc., etc. The key word is flexibility and choice. So basically, there's not going to be a massive shift from working into an office to working from home. It's more about a massive flex office and a massive work on the mobility of employees that companies are going to have to take into account. So of course it's not a neutral for what you call the occupancy market. It's not neutral at all. We believe that there should be about 10% less take up for France, for example, who is very who is less prone to working from home than other countries, typically the UK or even Germany or Spain, which is a champion of working from home. So we believe there will be a 10% cut in take-up in France, for example, due to the working from home trend. So it's not nothing. It's significant, but it's not threatening. It's not jeopardy on the office market as an asset class. But nevertheless, that means we need to seek, as an investor, more flexible offices, probably bigger offices, probably headquarters, because the more big the office is, the more you can implement some services, the more you can convert them into various uses of the space. So,
like build a community around the office.
In the office, around the office, and I would say with the office. the office of tomorrow is basically going to become more and more of a sort of tool for managing the employees, for attracting and managing the employees. So I'm actually quite ambitious about what the office market is going to become. Mm-hmm. But that means also that we need to be even more selective as an investor, because that means it's a bias towards new offices, flexible offices, and big offices.
And this would be mostly for core and core plus investment, right?
Yes, and this is essentially for CBDs, because of course location is still, of course, the major driver of office investment, as it has always been. We know that in Europe, there are huge projects in terms of infrastructure, transport. Grand Paris being one of the being the biggest infrastructure project in Europe today. So basically that means prime core and core plus markets are going to remain attractive.
Perfect. Let's talk a bit about the favorite subject of the season, ESG. In the past couple of years, the concept of sustainability and stakeholder-focused business has become widely and surprisingly popular. So Daniel, how is the framework on ESG reshaping the office market these days, or the market in real estate in general, if you want?
It's reshaping it completely. And to me, it's the more, let's say, it's the biggest game changer in the market now, because in terms of regulation, of course, you've got these frameworks, taxonomy, SFDR, so for Sustainable Finance Disclosure Regulation, which is driving all of the real estate funds and all of the funds in general to declare themselves as monitoring these environmental and social factors, and even setting some targets on by extra financial I mean environmental and social factors. So it's really, from a regulatory point of view, it's really a trend everyone is struggling with, trying to adapt. But it's not yet in the prices. It's not yet in the values. So
you mean, it's not tangible enough to be in the values or in the...
I would say the price of carbon, for example. Okay, everyone is talking about the price of carbon. So what's the price of carbon for real estate? We've got a few models for that. We've been working with the research team on these. But the basically when there's appraisal of a building, the questions raised are, for example, does it have this or that certification? That's not enough. Basically, we really need to integrate ESG criteria, and that means carbon, because carbon is the currency of ESG. I would speak of it as a currency of ESG. It's the one currency everyone agrees about. We have a carbon problem. So in the next months and years, I'm quite confident that the market will integrate carbon pricing into real estate appraisal. Therefore, we need to be ready to let's say, cope with this change of evaluation of our assets.
Okay. So carbon being the next currency.
Yeah.
Okay, perfect. So shall we now talk about healthcare real estate, Primonial Reim being the leader, I think it would be relevant and fair to share the perspectives on this asset class. Perhaps maybe a quick update on the past performance.
Well, real estate, of course, has been, let's say, a niche market. It's fair to say, healthcare real estate. So healthcare, first of all, what is healthcare real estate? Healthcare real estate is basically care homes, assisted living, and clinics. Okay, so it's homes for the elderly, for the dependents, and it's also short stay for, let's say, healing people, taking care of people, for a day or a few days. So healthcare real estate has been a niche market until, let's say, 2016. The average volume of investments for healthcare real estate in Europe was between, let's say, 1 and 3 billion per year. Today, it's more like between 8 and 9 billion per year that are invested in European healthcare real estate.
So can we say that the healthcare asset class has boomed since 2015?
Well, we can say that it has boomed, but it has boomed from very low levels, and it's still an alternative asset class. It's fair to say that let's say the 8 to 10 billion euros invested in healthcare real estate have to be compared to the, on average, 200 billion euros invested in European offices, for example. So it's still an alternative, but it's an alternative that is now considered by most institutional investors, whereas I would say around 2013, 2014, it was really considered a bit like data centers today, like a very, very marginal investment and often obsolete, etc. I would say the main...
in all markets in Europe?
Yeah, because actually there was no market at the time that was higher than a few operations a year, than a few hundred millions a year. So really what has changed completely the focus of institutional investors when it comes to healthcare real estate is that, first of all, tenants have become investment grade. Tenants in the field of healthcare are operators. Big operators. Most of the healthcare operators, by the way, in private healthcare are French. It's Korian, Orpea, Domusvi, Colisée. So there really are a few big operators. They've gone public for a lot of them, and now they're investment grade. They've really been consolidating. They have reached a size that makes them really interesting for institutional investors to have as tenants. And also, of course, in 2015, 2016, the yields of healthcare real estate were about 6 to 7%. They're closer to 4% today. So there has been massive compression in that field, and massive compression of yields mean, of course, value creation. So it has been one of the biggest, with logistics, has been one of the biggest success story in the last few years for real estate investors.
And as a quick reminder, Primonial REIM today holds
10 billion assets under management in healthcare real estate all over Europe. That's about 400 facilities. So you're right to ask a question, because size matters when it comes to healthcare real estate. Why does it matter? Because, of course, it's, as we said, it's an operator's business. The value you're going to create in healthcare real estate is basically, are you going to get a very long lease? Are you going to be able to renew a very long lease with a solid operator? And that means, of course, that the terms of negotiations, the terms of partnership have to be somewhat balanced between the landlord and the operator. Of course, it also means that the investment team in healthcare real estate, it has to be specialists. You can't just put your traditional office investment manager to buy some healthcare real estate assets. It doesn't work like that. And you need to be, let's say, big enough and important enough in the sector in order known enough, of course, and expert enough to, let's say, really understand what's the business model of these healthcare operators and try to build some partnerships, because it's about negotiation, so it's about partnerships, and basically we in real estate, in healthcare real estate, Primonial RM establishes partnerships with operators. So that means, for example, typically sale and leaseback operations where operators are going to sell us their real estate and in the context of asset light strategies, and they're going to become tenants of their own assets, and therefore for us as investors it's a steady income stream, and for them it's cash which they can reinvest in their core activity, which is curing people. It's not just managing walls. So that's typically a sort of
assisting people.
Exactly that's typically a win-win strategy, not only for us, for the operators, and for the people who are being cared of.
Perfect. The healthcare sector has been dominated by the German market, followed by the UK and Sweden. How does France stand, and what are your perspectives? First, from an economic point of view, and secondly, as an asset manager's point of view.
Well, France is one of the biggest, of course, under Germany and UK, but it's a liquid, it's a big player in terms of healthcare real estate, with very, as we said, very solid operators. The main trend, of course, is aging of the population. We know that aging population means, of course, more people into care homes, the need for new care homes, a situation of scarcity in terms of the beds that they require, and also populations who grow older require more healthcare goods and services. And assistance. So basically, we know that the baby boom generation, the boomers, as we say, are going to become more and more large in terms of proportion and of numbers in the French population in the decade 2020 to 2030. Basically, we're going to shift in the next 20 years from 2 million to 4 million people who will be aged 85 plus. At 85 plus, there's a big probability that you're going to be dependent or require some care outside of your home, and there's a lack of infrastructure, as the pandemic showed dramatically. We just don't have the infrastructure to meet the needs that come from this aging of the population. And by infrastructure, I mean public infrastructure, I mean private infrastructure, I mean non-profit infrastructure. All this needs to add up in order to build a real healthcare supply for every country. Some are in advance. There's also a cultural aspect, which is that countries like, for example, Italy, have a tradition of older generation and younger generations living together. Mm-hmm. It's not likely that this tradition will hold up for the next 20 years. We know that Germany, France have more individualistic cultures, and this tradition is no longer holding up, and that's why there's a scarcity, a need for these healthcare premises. In countries like Spain and especially Italy, the market is not institutionalized enough. It's not big enough yet for these cultural reasons, but there's every reason to believe that probably in a matter of years, Italy and Spain will come to the realization that there's a need to have a real, let's say, residential and healthcare premises to meet the needs of older people. Mm-hmm. It's not always about dependency. People who are heavily dependent, of course, it can't be taken care of at home. So we need these sort of assisted living or care home care home assets, but it's also about specific residential features. I mean, if you're 85 and you've broke a leg or something like that, or you're short in terms of mobility, then you're going to have to have some residential like assets, and you there's really a need to develop this supply in Spain and Italy.
Perfect. Shall we now shift to the residential market? We've seen that the pandemic ignited a home buying frenzy as the decade-long housing shortage converged with historically low mortgage rates, shifting workplace dynamics and new opportunities for young buyers to pursue their first homes. To question, are we expecting a whirlwind for the housing market? And secondly, what is the expected trend in the market in the demand-supply rebalance? Is supply expected to catch up in Europe, hence getting back to a certain equilibrium?
Well, if we had this conversation, let's say 3 to 6 months before the Ukraine crisis, I would have said that that residential is really the darling of today's investors in real estate for many reasons. I mean, during the pandemic, you've seen prices raised from let's say 4% in France, 14% in Germany on national average. So really great value creation from the point of view of an investor, of course.
In all types of residentials, in all markets, or everything.
Yeah, but especially multifamily, which is the in multifamily in what we call metropolis in France, let's say big cities. So basically, and that's for perfectly legitimate reasons, which are, of course, more people are attracted to these vibrant cities in Europe. The capital, the human resources, the cultural energy, all this is like drawn by these big cities in Europe, typically cities like Hamburg or even Nordic cities. So of course, and in all of these cities, there's a lack of supply because from a political point of view, it's not always easy to develop new assets. So shortage of supply and increase in demand, that means rise in prices. So it's quite mechanic, and it's reinforced, of course, by the fact that we've been living in a very low interest rate environment, which of course fosters residential prices. So now what I would say is that now that the financing conditions from the banks basically it's become increasingly hard to obtain a loan, and it's more expensive in terms of interest rates.
This is Europe-wise.
Yeah, that's everywhere in Europe, of course. Some countries have fixed interest rates, others have variable or capped interest rates, but basically the cost of money is more expensive now than it was a few months ago, and that's so that stops the residential. I would say a lot of residential investors now have a sort of wait and see approach, wait and see attitude. I personally think it's possible that in some markets we see some kind of correction, but generally speaking, I think the residential trend is going to
Fluctuate?
not fluctuate. I think it's going to increase, actually.
Okay.
Yeah, I think the residential forward trend is really here to stay, because basically, of course, the interest rate situation is a powerful driver, and of course, if there was an interest rate hike, like a sort of strong one and a rapid one, of course, I would change my forecast. But if the interest rate environment remains favorable, which is still the case today, I think it's a question of quantity. I mean, basically, there's just not enough housing and not enough affordable housing to meet the demands, and there's really a very strong demand from people in European countries to go and live in these cities where all the jobs are concentrated, the culture, etc., etc. So I'm quite optimistic if the interest rate environment doesn't change for residential. I also believe that there's a trend of institutionalization of residential investment. That's specifically visible in France.
What type of institutional investment are we talking about?
Probably talking about, I would say, insurance companies, banks. In France, it's specifically visible that there was a policy of letting everyone be an owner. 80% of people should own their own home. That's what was said a few years ago.
You mean the trend was to be homeowners?
Yes, exactly.
And now there is a shift
I
somewhere?
think it's shifting, and that means that if you're a tenant, that means probably if everyone's a tenant, that probably means that institutional investors own your homes, like it's the case in Germany, for example, where most of the multifamily assets are held by institutional investors.
Right.
And that's very important because it means that from the point of view of an institutional investor, residential is a steady growth. It's not an income-producing asset, but it's a value creation asset. And that's very important because in a context where there's not much value creation, I mean, normally the strength of the real estate market is more the income streams and the high income yields. So residential in this context is the only asset class where we can really see some real projections of value creation, steady value creation in the future. So I think from the point of view of an institutional portfolio, residential is a must-have today. But it's very difficult to source. It's quite difficult to manage. I mean, it consumes a lot of resources in terms of property management, and therefore there's a real market for investment managers in residential, I believe.
We've talked briefly about the shift in the perception of the traditional home. How are the investors meeting the needs for new housing models? And perhaps you could set the scene with what these new types of housings are.
Well, basically, it's about sharing services. So there are a lot of models. One of these models is build to rent, typically. Build to rent devices means that a developer is going to build a multifamily asset, and then each apartment is going to be rented to a family. And usually it works with lots of services, common services. So you're going to have, let's say, rents that may be a bit higher than the average market, but the addition of rent plus mutualized services is going to be cheaper than what it would be if you were an owner of your if you rented your home and consumed these services on an individual basis. So
and this would be in the cities, right? All around the cities.
Yeah, in usually these developments are in the cities, but it really varies from country to country. It varies with cultures because every country every population doesn't want the same services. Mm-hmm. So it's about studying carefully the cultural framework, what people like in terms of for example, do they like sports? Are they very prone to unite with the other members of the residential community? It's not the case in every country. It's very popular in the UK right now. We believe this model can be developed in some European countries, but of course it's really about finding the right concept in terms of services and in terms of pricing to attract tenants.
Perfect. So Daniel, before ending our conversation, I think we should remember what you said, that housing real estate, residential real estate, is the darling of the investment management so far. And I think our audience will be interested to know what are the issues to be watched in the coming months.
Well, of course, I won't be original on this, because the issue is inflation, how the Ukraine crisis develops, and basically the environment. My advice would be, let's try to go beyond the current situation, because when you're investing in real estate, you're investing for normally 5 to 10 years. So it's about trying to identify the trends that are going to last in the next 10 years. ESG is here to stay. Demographics, of course, it's quite a stable science. We know where demographics are going.
Unless there is another major pandemic.
Yeah, but actually the
old.
COVID-19 actually didn't have much of an influence on the overall mortality of the European people. And it was, of course, a heavy pandemic. So really, and demographics is not only the aging of population, it's also the urbanization of the population. So I think these are the trends on which any investors should focus. And my final advice would be, you can't predict, but you can prepare. So if you want to prepare, you've got to do some kind of asset allocation. We used to this in the field of equities, of course, less in the field of real estate. But today you've got enough of these big liquid markets. I mean, healthcare is more liquid, offices is liquid, retail is liquid. So you've got several sub-markets in real estate, which are liquid enough to allow you to perform some kind of asset allocation in real estate. It's not enough to say, okay, I've got a real estate pocket, I've got 100 million to put into real estate, let's buy an office and that's that, or let's buy a multifamily residential asset and that's that. No, you can allocate between different asset classes. That's the spirit in which we try to build our products at Primonial REM. Try to really what we call conviction-based real estate investments. That means trying to identify the specific features of each sub-market in healthcare, in office, in retail, in hospitality, etc., and really trying to deliver the performance and the features of that sub-market and allow our investors to manage their own asset allocation within real estate. So that's what we currently are working on at Primonial REM, and including the research team with a forthcoming report on this specific question.
Which gives us a teaser for the next real estate conversation with yourself, Daniel. So watch out for the next real estate conversation with Daniel Roy and his team, probably. Thank you for being our guest today. It was a great chat.
Thank you.
I'm Nuria Wazir, and it was a pleasure being your host for the REC by Primonial REM. Stay tuned for our next episode.